Good evening, ladies and gentlemen. On behalf of Team Azure, I thank each one of you for taking out time and coming here to celebrate World Investors Day. Now I request you all to please rise for National Anthem. As an investor, we are sometimes unknowingly doing a great job of creating wealth for ourselves and for society also. Now I would like to introduce Starcast of Team Azure. Although many of you know them well, but it is for the benefits of first-time attendees. Our first star is Rajendra Bhatia from Arthashastra. He is always willing to share his learning and knowledge through his Friday wisdom and Ravivar Suvichar. It has gained him a lot of popularity. Bhai of our group, Raju Bhai. Next superstar, Vinayak Sapre from VVS Ventures. Formation of Team Azure is his brainchild. Now he is very well known as Kabir. His book Dohanomics has been the best seller. It was launched last year in EVOKE 2017. He is also a coach and now trying his hands in stand-up comedy. So we can say he is a well-diversified portfolio. The third in line is another superstar, Gajendra Kothari, CEO of Attica Wealth. He needs no introduction, as all of you read regularly his articles in Mint Economic Times and see him frequently in CNBC and other business channels. Over the years, he has grown leaps and bounds. GK is an inspiration to many. The next Kothari is no lesser than the elder one. He is Nikhil, MD at Attica Wealth. He is very energetic, always ready with new ideas. He does lots of investor awareness programs. His latest love is running marathon. Our fifth star is Kamal Poddar from Saubhagya Investments. He is an introvert and soft-spoken. Kamal comes with lots of experience. We look up for his expertise in insurance. Our KP makes frequent visits to religious places. Next is Ronak Hindocha, CEO of IFA Now. He has high-end experience in technology and keeps us updated. He is our Ronnie. Following the queue is Saurabh Mittal, co-founder of Circle Wealth. He is a well-read guy who is passionate for blogging. He is gaining lots of popularity on Twitter these days. He is our CFO. Do you know the meaning of CFO? Chief Food Officer. Another co-founder of Circle Wealth is Mukul. He is an avid reader. Mukul is a workaholic, but at the same time he loves to go for long holidays. A firm believer in work hard, party harder. Can I call all the stars to shine in this time? All the stars from Team Azure, please come.
Thank you, Sanjay ji, and for the very creative, mesmerizing introduction of everybody. So as you can see, Sanjay ji is a very creative person, and we have been very blessed to have him in our group in Team Azure. As he mentioned that Saurabh is the CFO of Team Azure. He is also, we have designated him as CGO of our Team Azure. So CGO, any thoughts what could be? Because he is very creative, he is the Chief Gifting Officer and the fashion designer for our group. He is a very passionate and very committed person. Thank you, Sanjay ji, for this. So good evening, ladies and gentlemen. I warmly welcome you to the fifth event of Team Azure, EVOKE 2018. And we have been organizing this every year with the objective of enabling our valued clients to learn new things, to be more educated investors, so that we can take better decisions, not just in financial life, but also in our overall sphere of personal life. If you would have noticed the national anthem, I believe all of you, many of you would have already seen it earlier. I really liked this national anthem. It was very instrumental. It was only instrumental rather. There was no wordings to this. The very unique thing I liked about this was, even being instrumental, there was a lot of instruments which were being used to play. And at various point of time, the melody was coming out because of the divergence of many instruments, like tabla, the way Zakir Hussain played tabla, the way the matka was played. And this is how it happens in our investment portfolio also. So our investment portfolio is not just one or two instruments, but gets spread across multiple instruments and asset classes, which give flavor to our investments, to our portfolio, and help us achieve our wealth. And the objective of our Team Azure to host this EVOKE 2018 has always been to help our clients, help our investors understand what are those unique things, how we can structure our portfolio in a better fashion so that we are able to achieve our goals and objectives and aspirations and dreams. For those, I can see many regular faces in the audience. First of all, I would like to thank you all for continuously coming here and attending these sessions. This actually encourages us to come up with better content so that we can continuously deliver value to you all. If you would have noticed in the first year in 2014 when we started off, the tagline, the subject line of was viewer vision, what matters most, which was followed by the next 2 years were followed by the India economic growth story, and the topics were relevant to that. Last year we experimented a little different thing with the topic, what is investing? Is it art or is it science? And it was very greatly applauded and accepted by our clients, by all of you. We got very good reviews for that, which is why we thought, okay, what should we do this year? What should we be doing unique this year? So last year, instead of talking about economics or markets, we attempted to talk something which is called behavioral finance, behavioral science. Because eventually, as our last speakers, Mr. Krishnan Sharma mentioned, that it is neither art nor science, but a mixture of both, which is behavioral finance. So this year, we came up with this topic, greed and fear. Basically, we all are human beings, and what differentiates us human beings from animals is emotions. So we all have emotions. And predominantly, we are guided by emotion of greed and fear in most of our things that we do in our life. So we thought, how can we talk about greed and fear in a manner so that it appeals to us and we are able to understand at what time we are taking what kind of decision, what is actually driving our decision. So we have eminent speakers who will guide us towards this with their life experiences, practical life experiences and facts, so that we help understand that at any point of time, the decision that we are taking, either greed is driving it or fear is driving us. So please help me welcome Mr. Ajit Menon, CEO of DHFL Pramerica Asset Managers Private Limited. Mr. Ajit is he's an industry veteran. He has over 2 decades of experience in business strategy, distribution, sales and marketing. Prior to DHFL Pramerica, he was head of strategy at Tata Mutual Fund and has spent over 15 years with DSP BlackRock, where he played various key roles. Mr. Menon possesses valuable industry insights and is an excellent team player with very strong client connect. He has authored several papers on matters pertaining to mutual fund business and has co-designed a 6-month certification program in wealth management. I'm sure with his wealth of knowledge and experience, we will be benefited. Thank you, Ajit.
Thank you.
Over to you.
All right. Thank you, Mukul, and a very warm welcome and good evening to all of you ladies and gentlemen. I hope it is a good evening. I'm happy to be here, and it's a privilege to be speaking on the same dais as my senior colleague, Mr. Sundram, who you will hear very soon. He's got decades of experience as a practitioner in the equities market, and my friend and colleague as well, Peshotan Dastoor from Templeton. Very quickly, DHFL Pramerica as a mutual fund is, of course, a new kid on the block. We were formed in 2016 with an acquisition of Deutsche Mutual Fund. And it is essentially DHFL, which is probably the second largest mortgage company in India after HDFC, and Pramerica, which is essentially Prudential of the US. Prudential is the 9th largest asset management company in the world. And between these two partners, we think we have a good thing going here in India. But the topic for today is obviously not to talk about DHFL Pramerica, but to give you an idea of what Team Azure would like to talk about, which is these emotions of greed and fear. Now, I do want to set a little bit of a context before I get into my presentation. And that context is really important to obviously set, because one of the things that's very important, at least in my experience, has been by meeting thousands of investors and of course hundreds of advisors across the country, is to how do you keep a presentation very simple and drive the point as well. I'm hoping from my experience, and I know this, that by the end of my presentation, while I may have spoken about 5 or 10 things, there will be 1 or 2 that you will pick up, which will probably resonate with you as an idea, and that can probably help you within your investment decisions. So now, if you look at this very simple visual, this is exactly what Team Azure has put up as the topic for today. And this is by a gentleman called Carl Richards, who wrote a beautiful book called Behavior Gap. And he talks about how, as markets go up and down, individual investors tend to get sucked in towards the top as they see people making money. And then when markets correct, there is always a panic and a fear that sets in for most people. For the average investor, I don't expect this audience to be average investors. You have a very, very competent advisors advising you. But for the average investor, fear sets in and they tend to step out, and the cycle keeps repeating. So how do we understand this? And how do we understand this a little more in very, very simple language? So I'm going to talk to you about quantum physics. Very simple. Right? Now, why do I want to talk to you about quantum physics, which obviously for a lot of people will seem extremely complicated? Well, let's look at this man. And, a physicist, an astronomer, a mathematician, and if you look at that image there, there's enough clues in that image to tell you who that person is. Anybody wants to take a guess? Yes, it is Isaac Newton. And the reason I bring him up is because, as individual, as human beings, we obviously hold very, very intelligent people in very high pedestals, and obviously Newton deserves that. He was the person who, who had Newtonian physics named after him. What was the quality for Newton in the subject of physics? Newton believed that the physical world around us was precisely measurable. Now, in the time that Newton was a scientist, the church obviously ruled, and scientists had a very hard time. So if he had to be successful, he better make sure that the measurements that he did or the theories that he propounded were precisely measured, and nobody could question them. That was Newtonian physics. Everything was measurable in the physical world, and that's how physics was for more than 200 years before the advent of what is now called quantum theory or quantum physics. Now, to keep it still simple, what is quantum physics, or what does the quantum theory state? It simply states that Newton is wrong, that the physical world cannot be measured so precisely. All these electrons and whatever we have learned in school, if you try to measure their position, you can't measure their momentum. If you try to measure their momentum, you can't measure their position. And quantum physics came into being, and quantum physics is now applied in various fields. Now, there was one man who hated quantum physics. Okay, he was against quantum physics. Any guesses? Einstein. Einstein himself. He said, you can't make up a theory with a lot of maybes. It has to be precise. But you will be surprised to know that in 1933, finally, Einstein came around, and he himself nominated 2 quantum physicists for the Nobel Prize of 1933. He accepted that quantum physics is a reality. Newtonian physics, precise measurements. Quantum physics, probabilities. Only probabilities. Now you see where I'm going with this. The world of investing is all about a lot of precise measurements and a lot of probabilities that you need to deal with. When you think about yourself as an investor and you want to make decisions on investment, sometimes it seems like, okay, here's a stock, it's got a nice balance sheet, we know the business, you know what profits it's been making for so many years. This is what fund managers and analysts and people do. So if you wanted to really get a good sense of investing, if you know pretty much what is going to be the earnings of this company, what's the dividend yield, and what is the expected valuations for the future, you can pretty much make good bets in investing. But like Newtonian physics and quantum physics, your dividend yield and earnings and all of these things are reasonably measurable and almost precisely measurable. Market expectations, valuations as we call them for the future, is dependent on what is going to be the aggregate mood of millions of investors 3 years or 5 years from now. This whole thing about what valuations should we give to the market, what multiples should we give to the market, how much is this stock going to rise or the sector going to rise, is all dependent on what people are going to think in 2020. Millions of investors like you and me. In 2020, in 2025, wherever. Now, think about it. I know that I'm here on a Saturday evening. I don't know what mood my wife's going to be in the evening when I get home. And I'm supposed to be, or all of us as investors are supposed to be judging the moods of millions of investors 3 or 5 years from now to make that decision on investing. It's inherently almost impossible. And that is where you have the first or understanding within economics to say that you cannot have this precise forecasting, and it is all probabilities. You don't know when a Nirav Modi is going to pop up, or a North Korea is going to act up, or a Donald Trump will do something. Who knows? And what combinations are going to happen 3 months from now or 3 years from now? Nobody knows. Now look at an intelligent man like Isaac Newton. Let's look what happened to him. Here's his investments. Yes, he was an investor. This is his investment in the South Sea stock. Kept investing, got out, made some money. His friends started investing. They were making money. So he jumped in with all his money. The stock tanked. Newton lost all his money. And that's what made Newton say this: I can calculate the motion of heavenly bodies, but not the madness of people. Now, the point that I'm trying to drive here is that when it comes to these kind of fields like investing, we as human beings tend to intellectualize it too much. We tend to think that very, very intelligent people can give us everything that we need to know, and they probably are the smartest guys on earth and they can get it right. Doesn't happen. Let's look at one more example. These are two guys called Robert Merton and Myron Scholes. And I don't know if you've heard of the long-term capital management. It was a hedge fund, a company, an investment company. Both of them Nobel Prize winners in economics in 1997. Here's the company they started. Here's what their investments did at the end of it. Lost all its money. Nobel Prize winners, managing money, you would tend to think that they're a little intelligent to know where things are going. They didn't get it right. They lost all the money. It's a big case. My favorite, however, is this guy. I don't know how many of you will recognize him, and I don't want to make a quiz out of it, but this is again a Nobel Prize winner of economics in 1990. He's Dr. Harry Markowitz. And for most people in finance, Dr. Markowitz is one of the most famous individuals who gave us some beautiful theories in portfolio management. Understanding capital flows, understanding asset allocation, understanding portfolio management. This was a specialty. This is the man. And when he was asked about how does he manage his money, here's his answer. I visualize my grief if the stock market went way up and I wasn't in it, or if it went way down and I was completely in it. So I split my contributions 50-50 between stocks and bonds. That's it. A man who is supposed to be the father of portfolio management decides to just do 50-50. No complicated thoughts, no complicated ideas. Just go 50-50. Just have a balanced portfolio. This is Dr. Harry Markowitz saying it. Obviously, a lesson in it all for all of us is this, that we all tend to think that this area of investing needs to be intellectualized. It doesn't need to be. When you put too much intelligence into it, sometimes you get it wrong. So then what works? What works? Let's look at, no presentation in finance to a bunch of investors is complete without, one photograph at least of Warren Buffett and Charlie Munger, who are supposed to be the fathers of investing, and, people love them and people quote them all the time. And this is what they said: it is remarkable how much long-term advantage people like us have gotten by just trying not to be stupid. Instead of, we don't want to be consistently not stupid, instead of trying to be very intelligent. So it's simple. So now let me take you to the second part of my presentation to tell you that what is it then that is the secret sauce, or is there a secret sauce for this when we are managing our money? If we cannot intellectualize it, if intelligent people and Nobel Prize winners can't sometimes get this right, is there another way to do it? What do successful people do? So let me now keep it again as simple as I can and take you through what I think that any adult would want to be responsible for or take care of. Just these two things, right? Health and finance. We know it intuitively. These are two things that we as adults need to responsibly take care of. Why is that? Because if you don't take care of health and finance, they tend to come back and bite you in your future at some point. So what can we do? What is the best way to take care of finance? And ladies and gentlemen, this is the secret sauce of managing your money. The formula, not by experts, but by people who have, for years of having understood this field, understood economics, and by, Team Azure putting up this topic of greed and fear for you in 2018. It's also ironic because I don't know how many of you know that the 2017 Nobel Prize for Economics was won by a gentleman called Dr. Richard Thaler, who is considered to be the father of behavioral economics. All of the sciences as we know it is progressing, and people are getting more and more deeper knowledge about it, and behavioral economics has become more important than just plain economics. And behaviors are inherently all probabilities, moods of people. So let's look at the secret sauce of managing money. What's the first step? Spend less than you earn. The first step of managing money. I know millions of people who struggle with this first step. It's a bad world out there. There's a lot of aspirations. There's great lifestyles to be lived. And as we get the money, we tend to already allocate it in our mind to something that we already want. That's the first step of managing money. The second step, save the difference. As simple as that. The third step, take the help of a good advisor to invest in a diversified, high quality portfolio. And the last step, have patience. There is nothing more to managing money successfully than these 4 steps. You can write it down. Yes, good advisors, and the advisors like you have, will always tell you that insurance and writing a will is part of it, but that's stage 2 as you get involved with it. But in managing money, simply, if you had to advise anybody, or if I had to advise anybody, this would be it, these 4 steps. There's nothing more to it than these 4 steps. Why? Why, when I say that, I made that highlighted step of saying have a good advisor so that you can put it into a diversified portfolio, one of the reasons for it is because time and time again, there is research in the world of actual investor returns saying that investors' returns are always lower than the investment returns that keep getting published. Markets have been 15% compounded over so many years. These stocks did that and that. But if you ask investors in mutual funds or in their investments, have they made the same kind of returns? Mostly, they haven't. And why is that? Because investment success, and this is the latest coming out of behavioral finance, investment success is really not coming out of how much you know, but how you behaved with your investments, how you behaved with your portfolio. Dalbar Associates, which is a very large research company, and this is some data that's come out of the US, trying to figure out that what was the actual returns from the investment and what was the returns that investors got. So in this particular slide, and again, I don't want to make it too complicated, it is essentially the leftmost one is about what equity funds gave as a return and what equity investors in those funds got as a return. The middle one is about, balanced portfolios. What was the returns investors got, the market did, and what was it that investors got. And the last one is about bonds. Now, this is for a period of a good 29 years in the US. Unfortunately, data like this is not really available in India. It's being done by some of the agencies, but 29 years is a good time to say that that gap of why investors don't get the same returns as is usually published about investments is what's called the behavior gap. One of my own gurus called Nick Murray, who says that investment performance doesn't determine real life returns. Investor behavior does. So now let's look at what constitutes a good investment behavior. And while Richard Thaler won his economics Nobel in 2017, he would consider his friend and colleague and probably father figure Daniel Kahneman, who won his Nobel Prize for Economics in 2002 as one of the gurus in what actually helps people when they are managing money. Because we all know, hopefully by now, that there is so much of emotions that are tied in when we are trying to manage our own money, all he says is that find somebody who you can trust, who is in a different emotional state than you. This, ladies and gentlemen, is probably the strongest value of why you should not, as much as possible, try doing things yourself and let a good, trusted advisor take care of your portfolio for you, because he's going to be in a different emotional state than you. You're going to react differently. You know, amongst doctors, I believe there is a code that they wouldn't probably operate on their own family or their own children if something happened, because the emotions are so much that they could get things wrong. So a different surgeon would step in. It's almost like that. When we are talking about our own money, it's very difficult for us to keep our emotions aside, and we might get swung by that greed and fear as emotions. And the best thing, therefore, is to have the underlying principle is to have somebody you can trust who is in a different emotional state than you. And mind you, just like in doctors, you can't trust fully the advice that's going to come to you from your brother or your uncle or your friend, because they're also emotionally invested in you. They're going to make assumptions about you. That's the only value of having another advisor. The reason I stress upon all of this also is that I'm not saying it for saying sake. I've been in this industry long enough, more than 23 years of my career, 18 years of that in mutual funds. I do not manage my own money. For the last many years, I don't even know what's happening to my portfolio. Still, I review it twice a year. I've got a financial advisor who manages my money for me, because I find that's the best way to let things go, and I'm a happy man for that. So what helps, therefore, investment behavior is that it really requires discipline. You've got to be controlling your emotions, and we know that by now, and it can't be done by oneself or by depending on somebody who is also emotionally invested in you, which might be close family. If I had to give advice to anybody about then therefore how do I do it, I would say, if you're investing time, please do not invest time in trying to study stock markets and mutual funds and stuff. Spend time in interviewing your advisor for making sure that the person is most in sync with you. That's probably the best thing that you will do for yourself and your money. Why? And when you're choosing that advisor as well, and when you're doing this, what is then important? Like I said, the secret sauce of investing. What is then important if you have to control our emotions? What do you lay stress on? What becomes important? It's process. Process, because process is the only thing you can control. You cannot control the markets, you cannot control behavior, and focusing on process allows you to do one very simple thing: reduce errors. We talk about great sports people like Roger Federer. He's an amazing sports person, and what you will know about him is that he makes the least amount of forced errors that lets him win. He's playing a game and he knows that he needs to make the least amount of errors and he'll win the game. As simple as that. And even a guy like Roger Federer has a coach, has an advisor. Even at that level, he does need somebody to observe him, to tell him where he's probably going wrong. So it's process. So just in conclusion, if you had to overcome fear and greed as emotions, or just overcome your emotions, you don't need intellectual prowess. You don't need to put a lot of intelligence into it. You don't need forecasting ability as much. You don't need complicated ideas and products. What you need is a process that focuses on reducing errors. And of course, patience. That's what makes money. Ladies and gentlemen, that's all that I had in my part of the presentation for today. I'm going to leave you now in the capable hands of my senior colleague, Mr. Sundram, who is a practitioner in the equities market. And I'm sure that we will all be the wiser for the wisdom that he can give us in how he manages portfolio. Thank you very much, and I am happy to take questions, I'm sure, at the end of
Thank you, Ajit. Hello. Thank you, Mr. Ajit, for your guidance. So, Mr. Ajit pointed out about the role of an advisor, and because we have one of our team member who we fondly call as Sant Kabir, who has written Dohanomics also. Many of you know it. So I remember one thing that Kabir had mentioned in one of his dohas, and I would like to just put it across over here. Sadhu avat dekh kar, hasi hamari deh, matha ka grah utra, nainan bada sneha. So what does this doha actually mean? So sadhu, as in Dohanomics also, if you would have read it, or I would actually encourage all of you to buy a copy of the Dohanomics. It's available today at 25% discount also from CNBC. There's a counter over there. So what Kabir says that sadhu is like an advisor. So sadhu avat dekh kar. So when the advisors come to you, what we as Team Azure aspire to be, that sadhu avat dekh kar, when an advisor comes to you, hasi hamari deh, you should actually be feeling happy. Matha ka grah utra. So all the kind of tensions and inquiries or concerns that you have should actually come out of your mind and heart. You should be able to speak out. Nainan bada sneha, and you feel happy about it. So we aspire to be such advisors for you all that you can actually take out all your worries and concerns, download it to us, and be free about your financial worries. Thank you, Mr. Ajit, for highlighting this aspect of us. Now I would invite Mr. Sundram, Mr. E.A. Sundram, Chief Investment Officer, Equities at DHFL Pramerica Asset Managers Private Limited. Mr. Sundram takes care of, is responsible for the overall equity investment platform of DHFL Pramerica Asset Managers. He is an IIM Ahmedabad alumnus with over 26 years of experience in investment management in Indian equity side. His experience includes mutual funds, portfolio management, services, and family office investing. In his last assignment, he was portfolio manager at M3 Investment Managers Private Limited, managing the family office funds. Prior to that, he was fund manager of portfolio management services at HDFC Mutual Fund, handling portfolios of high net worth clients. He has also worked with Zurich AMC and SBI Fund Management. Over to Mr. Sundram. Thank you.